1 o'clock, I guess. This is who we have today. Well, I will go ahead and introduce myself. I'm Eli Howard. I'm Vice President Loan Officer at Premier Bank of the South in Coleman. I've been in banking for about 15 years. I spent about 10 years in farm credit, both First South Farm Credit and Alabama Farm Credit. But for the past 5 years, I've been at Premier Bank. We're a small local bank. We have about $325 million in assets, so that's not big, but it's not too small either. But if you are here trying to master your credit or learn how to improve or build your credit, you may wonder, what do you use credit for? The pictures on the screen here, you've got a house, you've got a car. Some of this may be personal to you. You may have student loans. And all of that requires credit or affects your credit. So like during this time of your life, you're probably planning for your future. You're working for a dream, like working towards a career. Working on this takes money, and many of you may have to work to pay for your education. And your education, like everything else in life, it costs a lot of money, thousands and thousands of dollars. Most people save money, yet will not have thousands of dollars to pay for something like school or a vehicle. Eventually, you may want to purchase a house, and I don't know if you've been following the real estate market, but houses are really expensive now. And so unless you have that much cash, you're probably going to need a loan. And so, with all that being said, you're going to need to plan ahead to be able to achieve these goals. And to achieve these goals, you're going to need credit. I found a quote that kind of matches with all of this. A good financial plan is a roadmap that shows us exactly how the choices we make today will affect our future. So for the next few minutes, we'll be discussing how you can create a good financial plan with credit. So today we will, discuss what credit is exactly, how to build your credit, how you can wreck your credit, and if you wreck it, how you can hopefully repair it. So what is credit? It's really where you borrow money and promise to pay it back. If we were at a college, so let's get academic with it. Credit is a financial arrangement that allows individuals and businesses to borrow money or access goods and services with a promise to repay the borrowed amount or fulfill the payment at a later date. It is essentially a trust-based and is a fundamental concept in the world of personal and business finance. There's various types of credit, many of which I'm sure you're familiar with. You've got like credit cards. It's really the most common form of credit. You make purchases and borrow money up to a certain credit limit, and then you must repay the balance, usually with interest, by the due date. Loans involve borrowing a specific amount of money from a lender, which is then repaid over time with interest. Common types of loans include personal loans, auto loans, mortgages, and speaking of mortgages, that's kind of next. A mortgage is used to finance the purchase of real estate. A borrower makes regular payments over a long term to repay the loan. Then you have like lines of credit. Lines of credit and revolving credit are a lot of the same. It's really a predetermined credit limit from which a borrower can draw as needed. They are often used for business purposes and can be either secured or unsecured. When we say secured, this means it's secured for the bank. The bank will take some sort of collateral, whether it is real estate or equipment, different things like that. They can also be unsecured, where it's basically a signature loan. There's no collateral, you just promise to pay. Installment credits, those are, typically like monthly type pays. Vehicle, a lot of times you'll buy a vehicle and pay for it over the next 5 years. That's an installment type loan. Revolving credit, that's like a line of credit where you can borrow on it, pay it back, and then borrow that same money again. And it's kind of set for a term, like typically about 12 months. You can, say you've got a $20,000 line of credit, you can, borrow $10,000, pay back the $10,000, then, go back and borrow $18,000. It's just it's an easy way to have an example or have something that you can kind of keep going back to. Credit cards are typically revolving credits because you can borrow the money and then pay it back and then use it again next month. So then, what is the credit score? When you go to a bank and request a loan, the first thing the bank will do is pull your credit score. This is a numerical representation of how likely you are to pay the bank back before they give you a loan. If you have a low credit score, that tells the bank that they have a good chance of losing money. The bank wants to help you, but if you're not able to pay the bank and they lose money, if it's secured, that gives them an avenue to, get paid back. So then how does a credit score work? There are the data collection that comes from credit bureaus. Credit bureaus, they collect data about your credit history from various sources such as credit card companies, banks, lenders, and public records. The credit bureaus, they then compile this data into a credit report for each individual. Your credit report will include information about your credit accounts, your payment history, outstanding balances, and public records like bankruptcies, judgments, and collections. Then the credit bureaus, they have a scoring model, which is typically the FICO or the Vantage score. That's how they calculate your actual credit score. These models, they use complex algorithms to assess your credit risk based on your past history and what you have open, at the time. These credit scores, the score range is typically between 300 and 850. The higher the score, the better your credit worthiness is considered. Who uses your credit score? Lenders, primarily. Like when somebody comes and applies for a loan, I'll pull credit, and it kind of gives me an idea of what you've done in the past and how likely you are to repay me. But other people use them, like landlords. If you're looking to rent a place, they'll pull your credit to see if you've paid your prior obligations, and if you've not paid them, they're less likely to, rent their space to you. Other people would be like employers, and they'll, especially if you're going into a financial role within an organization, a lot of times they'll pull your personal credit to make sure you can handle your money, because if you're not able to handle your financial lives, more than likely you can't handle the organization's financials at that time. So as a lender, I pull credit, but as a consumer, as an individual, you need to be able to kind of keep up with your credit score. And you may want to write this website down. It's annualcreditreport.com. You can access your credit report at any time. Through this website, you're allowed to pull one credit report from each bureau each year. And so there's three main credit bureaus, and so that's TransUnion, Equifax, and Experian. And so they kind of advise you to kind of break that up, so you can go to this website, create an account, and pull a report. But Typically, most of the credit bureaus will include all the same information. And so like, if you want to do it for a whole year, a lot of times it makes sense to say pull TransUnion at one time and then wait about 4 months and maybe pull Equifax and then wait another 4 months and pull Experian. And by that time, the next 4 months, you can pull your TransUnion again. So with this website, it does not give you a score, but it does show all the information that's on your credit report. It's always good just to keep a check on it. That way it helps you make a wise decision, and that way you also see what the banks see. How do we build it? How do we build credit? Building credit, it's really just a slow and steady race. It takes time and good decisions on a consistent basis, like along the way. It's hard to build credit. It takes time, but to wreck it, it is pretty quick. So it is consistency on repaying, your obligations that you said you would pay. So different factors that can affect your score. The payment history, that's one of the most financially responsible things you can do, is just to pay your bills on time. Payment history is considered when calculating a credit score, and it's important to the lender to see that payments were made on time in the past, because that's what we kind of expect going forward in the future. Credit utilization, this refers to the amount of credit that you are using compared to your credit limits. Like if you have a $10,000 limit on a credit card and $5,000 outstanding, that's a 50% utilization rate. Typically, you want to keep that utilization rate as low as possible, and that positively affects your credit score. Basically, in short, if you max out a credit card, then it negatively affects your credit score. The length of credit history. This kind of goes into, it takes time to build that credit score. But how long have you had the credit accounts? The longer, the better. A lot of times it's a good idea to have a credit card that you have, like, say when you're young in college, if you can keep that credit card account open and paid on time, and then if you can keep that for the rest of your life, that automatically helps your credit score. The types of credit. Having a mix of credit types, like credit cards, installment loans, mortgage loans, the diversity can positively impact your credit score, assuming, of course, that you continue to make all your payments on time. It helps to show that you've paid a variety of debts on time. New credit, applying for multiple credit card or credit accounts within a short period of time, that can actually lower your score. So really, you only need to apply for credit when you need it. A lot of times, most of these department stores, every time you go up to check out, they always ask you if you want, their store card. And if you do shop there a lot, maybe it's not a bad idea, but it's probably not a good idea if you get a new credit card at every store you shop at. One of the biggest steps in building your credit is, creating a budget. A lot of times you can qualify for a much larger, loan than you'd ever really be able to repay. And so, typically you want to borrow only for what you need and avoid borrowing for unnecessary expenses. Creating a budget, it allows you to see exactly how much you'll need and how much you have to spend. Typically, a lender, does not know all of the financial responsibilities. Yes, we're able to pull credit and we see what's there, but other expenses like utility bills, cell phone bills, insurance, none of that's really going to show in a credit report. But these are obligations that you have to pay, and so only you really know how much money you have available to repay a debt. And so really creating that budget and following the budget is one of the best ways to build and improve your credit score. So then while we're still building it, once you have the budget, you know what you can and can't do. Like I said, on the length of credit history, it's beneficial to not close old accounts. Now, just because you have the account doesn't mean you have to use it, but having an account that's open and available with a long history, that helps build that credit score. One of the most important ways to build it, again, is really just paying your bills and loans on time. Late payments, they have significant impacts on credit scores. One way to kind of help avoid all that is to maybe set up automatic payments, or if you don't feel comfortable making automatic payments, then at least set a reminder. Whenever the payment's due, have a reminder go off on your phone to just remind you to make that payment. Again, building your score, avoid opening too many new accounts in a short period of time. Don't max out a credit card. I've said to set up automatic payments, but the hardest perhaps of all this in trying to build that credit score is just be patient. It takes time to build credit, but only a short amount of time to wreck it. So what happens when you wreck it? How can you wreck it? The most common way people decrease their credit scores through late payments. The most severe impact on your credit report sometimes is a collection account. A collection account are typically past due debts that have been sent to a collection agency. When you fail to make payments on a credit account, even like a medical bill, the creditor may decide to sell or transfer the debt to collections agencies to recover some or all of the money that you owe. Now, once this happens, the collection accounts appear on your credit report, and it has obviously negative impact, but a collection account, it can stay on your credit report for up to 7 years. As a lender, when I pull credit and I see collection accounts, I always ask about them. And, sometimes we just mess up, we forget, but then there's ways to go about paying the collections back. And when I do see a credit report with collections on there, even after you pay it off, the collection still remains on the report, but it just shows it's paid. So when I see a collection account that's been paid, that I know that it hurts the score a little bit, or a good bit really, but when I see it's paid, it makes me feel a little bit better about that person because I know that they're willing to, fix what they have messed up. They're still willing to repay something, even if they went through a hard time. They may have struggled for a little bit, but they still go back and honor their debts before that. A judgment on a credit report are legal orders issued by a court that determine a debtor's liability for an unpaid debt. It's a lot like a collection, except it goes through the court system. So it does sound a little more official, but it's typically just like a collection account. It'll stay on your credit report for up to 7 years as well. And with a judgment, you can also find out where it is, what it is, and you can repay it. And so I kind of view the collections and the judgments about the same, especially if you have them paid. So in my eyes, it doesn't hurt as bad to see one that is paid off. But then bankruptcy, that's the most detrimental and long-lasting impact on a credit score. It can make it really challenging to obtain new credit or loans or even favorable interest rates for a considerable period of time. It can hinder your ability to get a loan for a car, for a business, or a mortgage. And then some employers, they look at credit reports, and so if they see a bankruptcy on your credit report, they are less likely to hire you. Not that they won't; it's just they see the history. The credit report shows your whole financial history in dealing with other people. So then, financial hardships through the bankruptcies, they can really affect your relationships with people and even affect you emotionally, because I imagine the financial stress of of going through these. And a lot of this, it's kind of tied back to, making that budget, knowing what you really can afford. But if you do find yourself in one of these positions where you have a lot of late payments, where you have collections, judgments, or even bankruptcies, there are ways to try to improve that. So in order to try to repair that credit, you need to keep checking your credit report. Like I said, on that annualcreditreport.com, that shows you what everybody else is seeing, and it shows you, really what you owe. And so while you're looking at it, you need to really try to pay off as much debt as you can as soon as you can. If there are any discrepancies on the credit report, you need to be able to dispute those errors. This is done by writing a dispute letter to a credit bureau, like Equifax or TransUnion. If you are going to try to dispute one, you need to be clear and concise and make sure you have the accurate information. If the error is resolved, this can actually boost your credit score. But remember to be patient on that, because disputes, they typically take a good bit of time. But you are entitled to making sure your credit report is accurate. And so, if you find something you can dispute, go through all the channels that you can. If your credit is really bad and you really don't see a way out of it, there are professionals out there through like credit counseling services. They can help. They kind of know the ins and outs of things. But before you do seek out one of those, you really need to research it and make sure that their reputation is very good, because there are a lot of like scam type people that are really just looking to take your money and not really help your credit situation. But overall, the thing that you do have to keep in mind on when you are trying to repair your credit is be patient. Late payments, they can stay on your credit report for 7 years. The collections and judgments, they can stay on your credit report for 7 years. Even if it's showing on there, the effect of that late payment does decrease with time. And so, if you have one late payment, it's not going to affect it for, that whole 7 years. And then like with collection accounts, they can stay on your credit for 7 years. Judgments can stay on your credit for 7 years. And then bankruptcies, they can, forget which one it is, but like Chapter 7 and Chapter 13, one will stay on for 7 years, and one will actually stay on for 10 years. So that's always something to kind of keep in mind. But in the end, it really is just be patient. Make sure you pay your bills on time. Like I said, only you really know your income and expenses and what you should be able to, really be able to pay back. But with all that, that's pretty much it on credit. Like I said, it's paying on time and only taking out what you can and need at the time. With that, does anyone have any questions? Yes, sir.
Are there any credit cards without any interest rate? Like you could pay off the month without any interest, or with credit cards, when you get a credit card and use it, and when you do pay it back, you always have to pay interest on top of that?
Typically, credit cards will allow you to use their money for a month, and then you get the statement, and if you pay the whole balance within that first month, then you will not have interest on there.
Thank you.
Anything else?
How do you know who you should go to, or what credit cards are best for what you need?
In terms of finding who's the best, there are a lot of there's a lot of sites and information that you can look and research through. Generally, you want to stick with like I said, like the reputable companies. you've got like major credit card companies. And for the most part, I would stick with them. But then you can, they have all sorts of different options. Some of them have like annual fees. Some of them have a little bit lower interest rate. Some give points. They'll give rewards. Some of that is cash back. Some of it's like miles for flying. It's really trying to find one that fits your situation, and there's not just one for everybody. It does take a little research to figure out which one's going to best suit you. Anything else? Well, I sure do appreciate your time today. And in the back, I did leave some pens and some like candy and some things. But I do have my card back there. I understand that, talking about credit and like personal finance, questions you really don't like asking questions in public. But I have my email address on my card, and it's on the screen. So if you ever have any questions or maybe need something a little more specific, feel free to shoot me an email, or I've got the bank phone number there. You can always call and ask for me. That's kind of what I do as a local banker. It's more about building relationships with people. And so if you need any help or have any questions, feel free to ask. So thank you so much.